The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. Guy Allard. How you doing, Guy?
Pretty good. Bear with me. Stuffed up, fighting allergies, but I'll hang in there.
Oh, man, you're not going to sneeze on the radio, are you?
I'm going to try not to.
For those of you new to the show, we developed this show to answer your financial questions. Too many advisors and too many brokers seem to, give you a bunch of Greek letters and try to show you how much more they know than you do, and honestly, they don't know more than you. They just know they've got a sales pitch down pretty good. We take it a lot further than that.
And even the consumer advocates out there won't mention their names, and there's a lot of them, whether they've got newspaper columns. Vic, it all seems like they have an agenda. I mean, they've got their own prejudices and their own things. So no matter what you read, it could be done with the best intentions, but you've got to read into it. You got to look into it, see where it's coming from, and not just take everything at face value.
Yeah, I saw a thing, no fiduciary, no business. You should never do business with a non-fiduciary. I don't know if I agree with that. We happen to be fiduciaries.
Right.
But I get the point. A fiduciary has to put your interest above theirs. You'd feel that all advisors are fiduciaries, but they're not. It's probably 10%.
I'd have to say no license is no business. What about that?
Yeah, the one thing is, remember, most advisors are biased. Most people are biased. I mean, it's natural. It's human nature.
Absolutely. Including us, right?
That's right. The closest way to get as unbiased advice as you can, though, is to have someone fully licensed. In other words, if they just do stocks, everything else is terrible. If they just do, say, annuities, well, everything else is terrible. The stock market's a casino, right? They just do life insurance, everything else is terrible. You got to go to an advisor that does everything, and they need to be compensated on every area because their own biases will come back in. Trust me, if they're not compensated on one side of the equation, let's say they do just stocks, not compensated on annuities. Trust me, they're going to skew you away from annuities no matter what, even if it might be the best thing for you, and vice versa. Same thing with an annuity person. They're going to tell you, well, annuities is the only answer you should ever do. When sometimes annuity is a good solution. Sometimes it's a terrible solution. You really have to determine that. You need somebody that's qualified in every type of area, and you need a lot of experience, number one.
That's where I was going to get ready to jump in. You got to have experience. With that supposedly comes some wisdom. Being fully licensed isn't the say-all, save-all, end-all, because you still have to look past that. Probably the worst example would be Madoff, right?
Oh,
President of the exchange, the whole thing, and still, but you've got compliance and you've got audits and you've got things. That's got to be at least a bare minimum.
It's like, I don't care what career you have, what hobby you have. If you think about it, let's say you're a rookie police officer and you're talking to a 20-year police officer, a 30-year police officer.
Right.
If you tell me the 30-year police officer doesn't know more just from their experiences, that doesn't mean the IQ of the rookie police officer isn't fantastic. Might have a higher IQ.
Absolutely.
Experience is everything. And especially when it comes to your money. I had a younger advisor, friend of mine, and we were actually having a beer on my patio. And he said, well, what if I was going up against you, Vic? And I said, well, what I'd say is that's a very sharp kid. You've got good taste because that kid's pretty good.
Little Marco.
The problem is he's learning on your money. I want somebody that's already learned what not to do.
Yeah.
And he goes, oh, that's terrible. I go, it's the truth, though.
Not just textbook knowledge, actual experience.
That's right.
Seen things go up and down.
That's why our advisors here have a lot of experience, right? 30 years apiece. And what you'll find a lot of times is this firm has 100 years experience. They could have 50 people there with 2 years each.
That's right. Collectively,
that's right.
100 years experience.
That's right. I hear that all the time. Collectively, 30 years experience. I'm like, well, how many people you got there? We've been doing this since the 80s.
Keep in mind, we started off this segment talking about different people have prejudice whether it's towards stocks or whether it's towards annuities or bonds. Obviously, you want someone that uses all the tools in the toolbox, but just like we talked about, being licensed is very important, probably the least credentials that you should start with having, and there's still bad people that are licensed, as we mentioned Madoff. It's the same thing with products, and why you really, in my opinion, correct me if you think differently, Vic, you shouldn't really be shopping products, looking for an annuity or looking for a stock. You should be shopping for a plan, because there's great bonds and there's some bad risky bonds. There's great stocks and great stock managers, and there's bad stocks and stock managers, as the same with annuities. So you really, in my opinion, shouldn't be shopping products. You really need to look for the advisor that's going to make all of that work hand in glove for your particular situation, and they're all different.
I agree with you 100%. What happens is, before someone makes a recommendation to you, they need to learn a lot about you. And it takes hours to do this. You can't do it over a 2-minute conversation. I'll give you an example. I've got a person that's implemented a retirement plan. They called their current trustee, which is a major firm, and said, "Well, I'm doing this." And they said, "Oh, you're not doing that, are you? That's we don't agree with that. We think you should do this." Now, put that in perspective. We have spent hours going over their risk tolerance, their objectives, a detailed accounting of their expenses, put inflation into the mix.
And modeled it for
That's
them.
right. And modeled the whole thing, 30, 40 pages of analysis, and to come up with some kind of solution for them. One person doesn't know that this is a big firm. They don't know anything about you.
And
They're 25 years old, and they're somehow giving you advice on what to do or not to do.
And Victor's not talking about them calling their advisor. He's just talking to the transfer department.
That's right. The people don't realize there's something called a conservation area. They purposely try to conserve accounts. And the easiest way to conserve something, you don't have to give them a lot of information. Just throw 1 ounce of doubt. Oh, you didn't do that. They don't know anything about it, but they just go, "Oh, I wouldn't do that." Ooh.
And this is your life savings we're talking about, right?
I had one guy say, "Who did that to you?" Anything. All it takes is 1 ounce of doubt. You could have 10 written things that make the most sense you've ever heard. 1 ounce of doubt is all it takes.
Now, it doesn't matter what you're bringing to them or where you're transferring their money to. Your money, I said their money, your money from them to, you're going to still get that same response, whether you're going to managed accounts, annuities, bonds, doesn't matter what you bring them, it's going to be, "Oh, no, not that."
Because that's why all you got to do is, if you don't like that, call them again, the next guy, and ask them, "Oh, I'm going to take this to Vanguard." Oh, they're going to tell you why that's a horrible idea, too. It's just the way it is. But those are people giving you a sales pitch. When somebody meets you and says, "I'm going to give you this whole pitch on this managed program. This is going to fit every solution. If you have 100,000 or you have 100 million, this program will fit you no matter what. Let me show you how." Well, then that's not an advisor. That's a salesman on a managed program. They're not taking account any of your information, because they pretty much have said every single circumstance this managed program will work. When it can't work in every single program, it can't work for every single person. What if you're a person that says, "I don't want any risk"? Well, we minimize the risk in this portfolio. We mitigate the risk. We hedge the risk. Whatever.
Low volatility this, low volatility that.
I just told you I don't want risk. If you don't want risk, you can't be in the stock market. I don't care what plan they have in place. My strategies at Dillon Gage are specifically designed not to lose, but they cannot be guaranteed not to lose. That has to be another type of product, like a CD, certain types of bonds, fixed annuities, stuff like that.
We've seen companies that haven't had a losing year for 25 years, and then what happens? They have a losing year.
Oh, I know. Personally, a trader did that till broke everybody the 26th year. Right. Somebody asked me the other day, "What do you mean broke everybody?" Gone, money gone, 26 years in a row, because I see that a lot. This program has never lost more than 4%. It has averaged 11% a year, no matter what happens.
I can put all my money there, right?
Absolutely. Put all your money there.
There you go.
You can't, one solution is not, that's a sales pitch. You're buying into somebody's sales pitch. It has to be a detailed process in order to give a recommendation with a basis.
And it has to change as you get older and your needs change, or it has to have that change built into it.
Because I tell you what, my life is not the same as it was 5 years ago, 10 years ago, 15 or 20 years ago. And when you get close to retirement age and in retirement age, it's not going to be the same then. Because when that paycheck stops, the psychological aspect of retirement will hit you. There's accumulation phase. They also call it retirement phase, where you're accumulating assets. That's what 90% of advisors concentrate on. How do we build the assets? And they'll still use that exact same plan, same exact funds, same exact strategy when you're in the distribution phase or the retirement phase. When the distribution phase is a completely different part of your life. Everything is different. You're not trying to accumulate the most assets. You're trying to ensure you never go broke.
And to be Yogi Berra-ish with this, what you've got in retirement is what you've got, and what you've got has to work.
That's right. Nobody's going to give you a loan to finance your retirement. You might get a loan to finance a kid's education, but nobody's going to finance your retirement. Be sure and call us, folks, if you have any financial questions you'd like to take advantage of our no cost, no obligation retirement income plan and Social Security optimization program. It's 972-715-2424. Again, 972-715-2424, or you can always go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. That's right, common sense instead of some sales pitch. Remember our philosophy. Our philosophy is, if you got so many bills and you're going to retire, you should have that much guaranteed. You got a check going into your bank account every month that covers your bills, and the rest of it, the stock market is a great place to help you cover future inflation or some trips or things like that. Fantastic. But you can't do those kind of things, especially when you're retired, if your bills aren't paid.
Well, we talk about all the time, Victor, and it reminds me of an old saying: you can't be a prophet in your own land, right? It's kind of like you are at home. You tell your wife something that goes in one ear and out the other, but yet your buddy says, "Oh, you need to treat your roses like this." And they, "Oh yeah, Dan said I needed to." I've been telling you that for 4 years. You never listen to me.
That's every wife in America.
It is. But the reason I mentioned that, Forbes had a great article, and they talked about the importance and the difference between accumulation planning, which we touched on in the first segment, and income planning, and the need to switch, which is exactly what Victor's talking about. But the one thing, and I won't bore you with the whole article, the one thread that went through the 5 or 6 pages of that article was you need a stable income plan. Stable income.
That's why we're going to talk a little bit about what kind of solutions we use for a typical retirement income plan, and why we're using them now when we could be using something totally different 10 years from now. Remember, anybody tells you something's bad, now private investment's a whole different story. I'm talking about legitimate investments. If you're talking about stocks, bonds, managed programs, annuities, life insurance, those are all legitimate stuff.
CDs, whatever.
Right, CDs. Anybody tells you they're bad is just trying to sell you something else or another idea, or they're making some biased opinion. They're just tools in a toolbox. You need all the tools. You don't want to go on a job without a hammer or a screwdriver or whatever. They work in certain instances. Some instances, a hammer is going to work perfectly, another, a screwdriver, etc. You need all the tools in your toolbox if you want to have an effective, rounded portfolio. And it's different. It doesn't matter what age you are. Diversification is key in a lot of instances, but income is key when you get to talking about a retirement plan. And so, we talked about this a few weeks ago. Interest rates have determined this. Somebody asked me, how come annuities are so popular last few years? I thought everybody hated them. Now everybody's talking about them. There's a couple people still hate them, but most everybody likes them now. What's going on? Is this just salesmen? Is it big commissions? What is it? I go, honestly, it's a product of interest rates. If you could get an 8% CD right now, the word annuity probably wouldn't be in your vocabulary.
At all.
That's just the way it is. And in the world we live in now, we have got low interest rates. We've been living in them for years and probably will for many more. Remember, we said this the other day. There's $19 trillion in debt. If we go back just to interest rates 4 or 5 years ago, you're talking about $500 billion more debt service. It's almost like the government committing suicide by raising interest rates too high.
Well, yeah, think if China was buying 8% bonds from us instead of buying 2% bonds. The debt service would be a killer.
It's a huge number. So the reason why annuities are popular now are one thing, interest rates. Right now, 10-year bonds are 2 or 3%.
Quite frankly, Victor, I know for a fact you and I, when we sit down with the client, we don't really tell them what to do. We usually lay out the different options. Here's what we do in a CD. Here's what we do in a bond, different bonds, risk level. Here's what a fixed annuity will do. The choice is yours. What fits.
So let's say you're a 55-year-old person. You're going to retire in 10 years. Let's just use an example. Well, normally in 10 years, you're going to have, if you need, say, $30,000 in income, well, at a 1% CD, that takes $3 million. I thought I would never say that in my life. $3 million to get $30,000.
For $30,000, yep.
But even if you're in those 2% bonds, 10-year bonds at 2% is taking $1.5 million. 3% corporate bonds, which there's some risk in there, it's still going to take $1 million. The reason why annuities are so popular right now is because you can take $300,000, $350,000 and guarantee yourself that $30,000 instead of $1 to $3 million. And so that is the main reason. Don't let anybody that's an anti-annuity person tell you it's because of commissions. Most fee-based person, which I'm a fee-based guy too,
Sure.
we manage stocks.
Yep.
You're charging 1 to 2% on a growing asset. It makes more money than any annuity commission that I've ever heard of. Much more. And so it's not the fee,
But
it's the interest rates.
But it's not appropriate to put all their money there either.
No. But you've got, and that's mainly it. If you can get a better income stream, now right now, if you can get better than that, let's say you can get 5 or 6% high yield bonds, they are extremely risky. And somebody tells me, well, for 20 years, we haven't lost a penny on them. But the interest rate's been going down for 30 years. You shouldn't have lost a penny on bonds at all for the last 30 years. But if interest rates go up, what's going to happen? You're going to lose exponentially on a high yield bond fund versus an investment grade bond
What's
fund.
the ratio on the movement down for loss?
Every 1 point, you can lose between 8 and 15%.
There you go.
Every 1 point movement, depending on the duration of the bond, the quality of the bond. And so you can lose a lot of money in a bond fund right now. But that's the reason why use an annuity. The ones we like now, variable annuities are still, the fees are too damn excessive. I should have cursed, sorry about that. But it's too excessive.
It's true.
Right now, I'm seeing them paying 3 to 5% in fees. Now, anytime you pay somebody 3 to 5%, one side of that table is extremely happy and smiling to the bank. The one that bought it is never going to be happy because you can't fade a 5% fee.
And and we can offer those as well. And if they paid a lot, we would. I guess we got a break coming up, but there's a lot of other things than the fees into the annuitization and the income guarantees of those.
So just, in my opinion, to stay away from the variable type annuities. They do produce income, but the fees, I think, outweigh the benefits. I'm not telling you they're terrible. They're just too expensive. Stay with us, folks. We got a break coming up. Don't hesitate to call us if you have any questions. 972-715-2424. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Right before the break, we were talking about how a lot of income plans are populated with some type of annuity lately. This is a more recent phenomenon than the last, say, 10 years or so. And it's not because annuity guys selling annuities want more commission because fee-based guys make more overtime than annuity guys. It's because of interest rates. Interest rates have got to the point where can you imagine tying up your money for 5 years for a 1% CD or 10 years for a 1.5% government bond? It just doesn't make sense to me. I don't know why anybody would buy it, but they do. And so if you need more income per dollar, annuities pay more. You could, like we used an example, instead of $3 million to produce $30,000 with a CD, $1 million with a 3% bond, $300,000 in the example we used would produce the same $30,000. And so it allows you to put a lot less towards it. We talk about what type of annuities that you might want to consider for a retirement plan. Don't get me wrong. You can always use bonds. You can always use CDs. You can use dividend-paying stock. It just takes more money. You got to put 2 to 10 times more money to produce the same income. But if you're more comfortable with that, there's nothing wrong with it. Okay? I'm a guy that says, in my income bucket, remember you got buckets of money that you have. My income bucket, I'd like it to be, since it's going to be the most restrictive, either a 10-year bond or a 10-year annuity or something, I want that to be the smaller piece, not the bigger piece.
Vic, you and I were talking at lunch the other day. We've got a great bond department that we work with. These guys do a ton of business. And with rates the way they are right now, no one wants bonds. I mean, they're just absolutely doing nothing. Not because bonds aren't good.
Right.
They just can't compete today.
Just like I said, somebody tells you CDs are evil. There's nothing wrong with CDs, just the rate they pay. And that's what it is. So the place we live, you can't think of the past. It doesn't matter what interest rates were in 1981. It doesn't matter what they might be 5, 10 years from now. You got to live in now. What kind of plan can you put together now? And have it adjustable. In other words, you can't have it illiquid. So if interest rates do skyrocket, you're able to change your plan and adjust your plan to the new reality at that time.
Absolutely.
But that's why I don't lock anything for life. I'm not locking anything for life just in case my 8% CDs come back.
That's right. That's right.
You got to have something for that. Variable annuities, in my opinion, aren't the best thing. The benefits have come way down and the fees have gone way up. And so remember, we're not telling you annuities are good or bad, but they just require less amount of money to produce the same similar income. And variable annuities are too expensive. That's my biggest problem.
And a couple other things without getting too in depth with this thing. We talked about the fees on variable are much higher than the fixed is almost nothing. But also with a variable annuity, if you kick in this income guarantee, which is how they're selling them now and part of the riders and part of your cost and why it's more expensive, once you start getting income, it's like the old immediate annuities. Your money is gone. Now, you'll get that payment forever, but the money's gone. What we use is different. We use fixed index annuities. You can take the income, you can stop the income. You can access the funds, you can turn it back on. But more importantly, when you turn on this income stream, each year it still can earn money based on what the market does. You don't take down years. On these other ones, once you take income, again, your bucket of money is gone. With these, you still have your bucket of money, and it still earns each year. And if the market loses, we don't make anything, but we don't lose. If the market makes something, we make money. The income comes out, the earnings go in, and you still have a running tally. It's a very, very good thing.
It's predictable, steady income, and much more income per dollar than other fixed interest rates investments. And that's what you're trying to do. I'm trying to get the most income out of my money. If I have a little extra every month, that's a bonus. But that's a real plan. It's not, I'm going to try to grow my money to a certain level and then hope it works out, because you're going to use the same people. If you talk to a person, well, some of these people that sell managed programs, say you're 35 years old, and then you call them back later and say, and change your voice a little bit, I'm 65 years old. How much you want to bet your plan's the same? It's going to be the same managed plan, except for they may put a little more bonds in your 65-year-old piece, a little bit less bonds in your 35-year-old piece. It'll be the exact same product. The equity portion that will be the same exact product. It won't be any different. Well, that can't be. A plan for a 30-year-old can't be a plan for a 65-year-old.
And that's why it's important to see if you knew the difference once your income is taken care of. And remember, that's our philosophy, right? You get your hard expenses taken care of. You're no longer in the accumulation phase, right? You're in the distribution phase. If you're still all in the stock market at that point, we've talked about it hundreds of times, the market's down, you're withdrawing, it can be an irreversible mistake. Whereas if you've got your hard income taken care of, and hopefully we'll have time to maybe go through some case studies with you, but not only can you take care of your income, but you can have it set up where you've got more income than you need, so you're actually saving money off your income stream. And what that does to the rest of your money is allows that the freedom to grow, and you don't have to stress about it. It really looks great on paper.
I see a lot of advisors who, like I said, we like using index annuities because of current interest rates right now. But we're going to show you the other annuities that people use as well, why you should or shouldn't do those after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Sorry, I had to get my volume up. Welcome back to the show. Before the break, we're talking about why annuities are so popular now. It's mostly because of current interest rates. Has nothing to do with commission and things like this, because fee-based people make more.
They're
over
so,
time.
they're
It
so
had nothing to do with it.
they're so popular now that you've got big time money managers running ads about why they hate them
No,
because there's so much money going into them because they make sense now.
well, even some of the hardcore, like they'll tell me, I've read everybody, by the way, out there that
Absolutely.
hates them, loves them, and all that stuff. And some of the reasons say you should only do an immediate annuity, the old school, been around 1,000 years, a pension annuity, because of the simplicity. In other words, index annuities, variable annuities, way too complicated. Immediate annuities, they aren't complicated at all. That's true. Put $1 million, we're going to give you 60 grand a year or 50 grand a year. The only problem with that is they're based on current interest rates, and they're going to assume these low, worst interest rates we've had in history for the rest of your life. So you will lock in the worst rates in history for the rest of your life, only with immediate or deferred annuities, not index annuities or variable annuities. But you'll lock in that rate. And I'm telling you, they're only going to assume you're going to make 1% a year or something. So you just locked in a 1% gain on the balance the rest of your year. And the money's gone forever. So if you and your wife got hit by a bus after you got your first payment, they're keeping the balance. Well, I don't understand how these advisors can say that's the only thing you should do. I'm not signing an irreversible decision for a lifetime decision ever.
And remember, when you query this stuff on the internet, what comes up other than the ads, what comes up on the top of the list, the stuff that's the most active, the stuff that's out there, not necessarily the most pertinent, best information. Perfect example, Victor and I talked about an article, a month or two ago. Nobel Prize winners in economics, professors, they like the income and taking care of your hard expenses and all of that first. You just don't see them plastered all over the internet because they're a professor, they're doing a paper, they're not paying for the advertising. Where this other stuff, that people are paying for it, and that's what comes up when you query things.
You can get study after study that shows you should have your expenses paid by a steady income stream, and that annuities are probably the best one at this time. The only ones that don't are people that are selling you something else. You know, Ken Fisher's big about hates annuities, blah, blah, blah.
There it
He's trying to
is.
sell you a stock market deal. He doesn't sell annuities. He sells stock market thing. It's just a marketing thing. And there's nothing wrong with Ken Fisher. He's great. But it's in the stock market realm. You can't say every single human being should be in the stock market or every single human being should be in stock annuities. Both accounts are ridiculous. Okay. But
You talked about earlier having the right tools for the job. If you're getting ready to mow your yard, you're not going to use the same tools that you do if you're going to replace your roof, are you?
Right.
No.
Well, even Scott Burns loves immediate annuities. But it used to be a lot of this is antiquated information. What they're looking at is information from 20 years ago. When I started doing this stuff, you could get a 65-year-old couple, joint life annuity, $1 million, paid them $85,000 a year for life. Well, $85,000 a year for life on $1 million ain't bad.
It's a great number today, isn't
Even though you can lose control of your principal, that ain't bad. But now it's like $55,000. And you can get an index annuity to pay you 60 or 70.
And keep control of your money.
That's right. You keep control of the money, and it still grows, and you can change your mind.
It's reversible, exactly.
Yeah, that's a completely different animal. So if you weren't using antiquated information, remember, folks, I was a nuclear chemist. It's just numbers to me. If you look at the numbers, and by the way, any financial advisor out there, I dare them to show me the numbers, because I'll show you mine. I'll show you the numbers to show you what you're talking about is wrong. In other words, you say that if this advice, if you can prove to me in any stretch that somehow I'm wrong in giving income per dollar, this pays this much income, your bonds, your stocks pay this much income, and what if a person needs this much? I will dare anybody to argue this point with me. Any advisor, any individual person. My number is 972-715-2424. You can go to ilovemyretirement.com. You can email me at victor@victormcclure.com. I would love to debate. I'll do it on the air. Anybody out there that says you should do this and not do this.
And also, if you're listening and you're intrigued, but yet you don't want an information pack, you don't want to be inundated with brochures and spreadsheets and charts, call us. We're happy to discuss it with you on the phone, kind of go through some numbers, give you some ideas, and see if it makes sense.
Yeah, it's 972-715-2424. But before we do any of that, just because an index annuity might guarantee a 6 or 7% growth for income, give you up years of indexes, no down years, lock in your gains as you go, it's tax deferred, judgment proof, those are all pretty good things. We're still not recommending it to you until we do some background.
And certainly not with all of your money.
That's right. And what you've got is there has to be an accounting of your assets. All right. Now, assets, this is not a financial statement. You're not going to put your house that doesn't produce income on it. These are investments that could produce income. You can use rental properties if they're producing income. Just when you're stress testing rental property, just don't have it 100% lease forever, because that's not likely forever.
No maintenance.
Yeah, that's right. Zero
No
maintenance.
taxes.
It's always going to make me this.
Yeah.
Be realistic with it, right? You've also got to take an accounting of your income. What are your pensions, if you have any pensions? How about Social Security? And then you've got to determine from that your expenses. All right, how much are my expenses? Then you got to say, okay, I've got income of this coming in. I've got expenses of this. I've got a shortfall. My potential retirement could have a $4,000 a month shortfall, $5,000 a month shortfall.
We talked about it last week, asking somebody what their expense is. It's a hard number for people to come up with.
Oh, absolutely. But you just come up with some kind of idea, and then you've got to inflation adjust. In other words, the average inflation rate the last 100 years has been about 3.2%. Now, the last 10 years only been about 1.9% because the government's held everything down artificially. But you do all of that, then you stress test the portfolio. Trust me, if you save $2 million, you make 40% a year, you're fine. That's not a stress test. That's not a retirement plan. That's a dream. So
amen.
What if it doesn't make anything or makes a small amount for years? Does this mean I'm eating cat food when I'm 80, or does it mean I'm fine? That's the things that we determine for you. Stay with us, folks. We got a break coming up. You're listening to the Common Sense Investing Show, News Radio 1080 KRLD. And by the way, don't hesitate to call us at 972-715-2424 or go to ilovemyretirement.com.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. What we're trying to show today is, with the whole reason for this exercise, is we do things different. We're determining a lot of things. We're going to put a lot of time and effort into determining possible solutions for you. Anybody that tells you their managed program is the only thing a 20-year-old should do or a 90-year-old should do, no matter what their income level is, no matter what their expenses are, that's just selling you something. Anybody that tells you an annuity is the only thing you should ever look at, don't even look at that Wall Street casino. They are just selling you something. That's not advice. That's a sales pitch. I don't like sales pitches that much. You give me the numbers, and that's what we do. We're determining your assets, your income from your retirement income, like pensions, Social Security, and all that, what your expenses are. We're going to break those expenses into two categories. One of them is going to be your floor. What's your hard expenses? In other words, one thing I can't live with in Texas is air conditioner, without, I mean. And so electric bill has to be paid. Number two, water. I don't think we can live without water, and all the other things. Now, it's arguable whether a housekeeper and stuff like that and the pool person is hard expenses. You might put them in the discretionary pile, right? But then you've got a desired expense, like your discretionary expense. So you've got your expenses, hard expenses, then desired or discretionary expenses. All right. Then you've got to inflation adjust it. Because anybody tells you if you got $5,000 a month in bills now, in 20 years, it's virtually impossible to have $5,000 a month in bills. Unless somehow the electric companies are going to start charging you less over time, or the water company, or the grocery store. I used to buy a whole cut-up chicken for like $2. I guess I'm showing my age, or $1.
Yeah,
now
it's not that anymore.
No, I think it was 50 cents for
right.
if you want it, if it wasn't cut up. Now it's $15 for one or something.
I'm going to mess you up here, Victor. Think about this for a second. You've listened to the show for quite a while. And take a different tack. What if you could just fine-tune what you have and make it more efficient? What I mean by that is, let's say you feel, with the numbers you've done, that you can withdraw $7,000 a month from what you have, and you should be okay. What if you could just rearrange, fine-tune, protect some of that money, and change that $7,000 where you got $10,000 or $11,000 a month coming in?
How about guaranteeing it for the rest of your life with inflation?
Same money, just fine-tuning what you're doing.
But we're doing all this. We're gathering we're gathering the information, gathering your income, your expenses, inflation adjusting, then stress testing the portfolio. Then we analyze the results. Okay? Then we make recommendations based on your hard expenses or based on your desired income level, whatever you prefer. But that's the kind of information you need to make any kind of investment recommendation. But I'll tell you what, you call 99% of every advisor out there, They're going to tell you, no, I got this great annuity for you. I got this great managed program for you. And they haven't heard a thing about you. Don't know anything about
I
it.
tell you what's weird, though. You find out the more income, and, of course, the more money you deposit, let's say, into a fixed annuity, the more income you get, the more time you defer it. But you'll find the more income you have coming in, the more other money that your other assets will grow. It's weird.
Remember, it
how
doesn't
that
have
works.
to be a fixed annuity. It's just they pay a lot more income per dollar. We can do it with a bond portfolio. You can do it with a CDs. If you want dividend paying stocks, people are comfort people. They like things they're
Familiar
accustomed
with.
to.
That's right.
If they're familiar with it, they're more, even if it could be bad, they've got bad, they're familiar with it in a bad way. They'll still do it. It's amazing to me. Some people say, well, I think I'm just going to stick with this. Well, didn't you hate that thing? You thought the fees were too high. You've been losing money forever, blah, blah, blah. Or it went down 50% twice. Yeah, but they talked to me and said they didn't think it was going to happen again.
It's coming back.
That's right. You can't make mistakes like this when you're retired. So that's why when you're planning for retirement, you got to make something that's bulletproof. You can't have any kind of retirement plan based on my electric bill is going to be paid this month if North Korea doesn't attack South Korea and England doesn't leave the European Union. Oh, that's already happened, right? You can't base it on anything happened geopolitically. Or if the stock market goes up, my bills are paid. Stock market goes down, I can't pay the bills.
And whether Hillary Clinton or Donald Trump get elected, you can't let that paralyze you from taking care of things and making it more efficient today.
And you can't wait for better times. That's what people did for so long. Oh, you know how much money it's cost people keeping everything in a money market waiting for a higher interest rate? You could have just got 2 or 3% and made a fortune in comparison to keeping it in the money market.
Absolutely.
Now, there are a couple money markets out there that weren't too bad. I saw some 1 or 2 percenters. Well, it's pretty good on a money market.
Extremely.
You got to shop a lot.
Today.
Then, after about 6 months, a year, they'll change it and you got to move it again. So if you're okay with that, I'm a kind of a creature comfort guy. I like staying in one place. Just give me a decent shake right off the bat and I'm okay. But I get it if you're not. But the importance of this is you need some kind of retirement plan. Even if you're not in retirement age, we will do more for you than an average advisor you're calling on the phone. It's amazing to me that this one discount broker, I'm not going to mention the name, I love them actually. They do index funds really cheap. They're great. But they told a client of mine, oh my gosh, you should do our managed program. That's the only, that's what most people are. I'm like, they know nothing about this customer. Nothing. All they know is this is a number. And this was about $1 million account, which to this company is nothing. So you're some small number on a ledger. You called into a customer service line, and this customer service representative that's probably not even licensed, it could be 23 years old, is telling you what you should do with your money,
That's right.
giving you advice, and they don't know anything about you. Before anybody gives you advice on your investment portfolio, your retirement portfolio, they better know something about you. And that's what people have done it forever. No, this guy sounds pretty good. I checked him out. Pretty good. They don't know anything about you. You can't have your advice based on that. Have somebody do some real research and analysis for you. Then the recommendations have some kind of basis behind them. Don't hesitate to call our hotline if you'd like to take advantage of our retirement income plan, Social Security optimizer, or just like to chat. 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. I'm Victor McClure. For Guy Allert, we always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.